There are very few people who can afford to pay cash for a house, so at some stage you're going to need to take out a mortgage or a loan to do that. With me today is Peter Bull, mortgage broker, who's going to discuss that with us. Thank you for joining us, Peter.
Pleasure.
Now Peter, before you can borrow any money, a lender needs to be satisfied that the client can actually repay that money. What are some of the things you look at in assessing a loan application?
Well, I've been lending for nearly 40 years, so it hasn't changed in all that time, but the two most critical points are the income to determine how much they can afford to borrow, and secondly is the amount of money that they've got or support to put towards the purchase. Obviously important is their credit history to make sure that they haven't had any bad credit ratings in the past, and also the suitability of the property that they're buying based on comparable sales and that the property is suitable to the lender that is going to give them the money.
In your experience, Peter, what is the most popular loan option?
The most popular loan would be a variable rate loan so that people can pay extra into their loan and try and reduce the term as quickly as possible. In the 1980s, when I was lending and the interest rates were at 16 to 18%, in today's market, you've got rates now in the high 4s to low 5s. Fixed rates are also very popular, but by overall, the variable rate would be the most popular product.
Do people generally fix their loans, or do they look to take out a variable loan?
It depends on their personal circumstances. Some people it suits to fix for something like an investment property. They may want to go interest only, but the general if someone's going to live in the house as their own principal place of residence, a lot of people will go predominantly variable, but in this low interest rate market, a lot of them are actually splitting the rates and hedging their bets to just give them that safety factor of knowing for certainty for a set period of time, and they may fix it for 2 to 3 years.
Thanks so much for joining us today, Peter, to give us an insight into the loans and the difference between variable and fixed. If you've got any further questions, please don't hesitate to contact us.